We are with WC Investment Bank, and we are going to walk you through our valuation of Cerenimbus software development. We will give our analysis of the different offers for Cerenimbus, followed by our proposal. We will first give an overview of Cerenimbus, describe their future plans, industry forecasts, and lastly, the firm's projections. Cerenimbus is located in Orem, Utah. They have been in business for over 24 years and specialize in mobile applications, websites, and desktop applications. In addition to their offices in Utah, Cerenimbus employs 60 programmers located in the Philippines. The CEO of Cerenimbus is Kirby Glad. Cerenimbus plans to grow their foreign operations starting in 2020. They plan to expand to Bangalore, India, and add 30 full-time programmers to their workforce. They plan to utilize blockchain technology to enter into a few different markets. These markets include gaming and entertainment, as well as individual investor to individual investor stock trading. We used US GDP growth to analyze the future economy, which is a key driver of industry growth. This data suggests an average growth rate of 1.9% over the next 5 years. We also looked at the unemployment rate, which is expected to decline to 3.56% by 2020. Cerenimbus' average annual growth rate was 14.92% from 2015 to 2018. Historical growth in the software industry has been about 7%. There are projections of high growth in new technology and moderate growth in traditional technology in the coming years. I will now go over some projections given by the company. Here are the firm's sales projections for 2019 to 2024 with actual numbers from 2015 to 2018. On average, Cerenimbus' historical sales growth is about 14.92%. They have forecasted sales growth of 15.49% for 2019 and an average sales growth of 15.68% for 2020 to 2024. For expenses, the dark blue bar represents expense projections without adjustments, and the lighter blue bar represents expense projections with adjustments. These adjustments are reductions in expense due to developing more efficient production methods, improvements in employee efficiency, and establishing relationships with customers or suppliers. These expenses are based on revenues. I will now go over operating margin. From 2015 to 2018, operating margin was about 19%. Operating margin has recently decreased to 17.46% and is expected to remain at 17.46% until 2024 if expense adjustments aren't considered. Operating margin is expected to increase to 23.83% if expense adjustments are included. We will now discuss the valuation of Cerenimbus from both the company's perspective and our view of the company.
We will first conduct evaluation based on the offers. We got presented with two offers. The first offer is from an investor within the private equity fund that holds the majority stake in the company. The other offer is from the firm's management. The offer from the investor within the private equity fund wants to buy out the entirety of the fund's interest, which is 56%. The investor also wants to pay off outstanding long-term debt. Also reduce Glad's position in the firm down to 10%, which is currently at 40%. This valuation is based on the management's projections or forecast without adjustments. We'll use a discount rate of 20%. The other offer is from the firm's management. This is a bid on the entirety of the company. This is based on the projections with adjustments. We will use a discount rate of 22% for this offer. We will conduct evaluation based on the firm's own projections. We will first look at the projected free cash flow, then conduct evaluation, and then give a value per share of both of the offers. Here we have the free cash flow projections. 2016 to 2018 is the actual historical free cash flow from previous years. 2019 is an estimate, and 2020 to 2024 is the management's own projections with and without adjustments to expenses. We have estimated a value derived from an income approach using free cash flow as our cash flow and that 3% long-term growth rate for our terminal value. For the single offer, which gives a present value of the DCF of 2.3 million. The terminal value is going to be 7.2 million, which gives an expected enterprise value of 9.5 million. From the management offer, we get a present value of 2.5 million of the DCF, a terminal value of 7 million, which gives an enterprise value of 9.3 million. To find the estimated share value for Cerenimbus, we subtract the market value of the long-term debt from the estimated enterprise value, and then we add back cash and cash equivalents. We then divide the estimated equity value by the number of shares outstanding to get a value per share. We have for both offers a long-term debt of 7 million and cash equivalents of 2.5 million. We also have 3 million common stock shares outstanding, which gives us a value per share of 1.68 for the single investor's offer and a value per share of 1.62 from the management's offer. Over to our evaluation. We'll start to look at our take on Cerenimbus. We believe that the revenue projected by the management is overly confident. This is based on historical growth and expected industry growth in the future. We also believe that they are pressured by the private equity fund to deliver better forecasts. The firm is also highly leveraged with a debt to equity ratio of almost 3. The CEO is one of the key employees, and we believe that there will be a risk if he gets replaced. And according to Glad himself, it takes 2 years of training to replace him. We also think that they could utilize the Philippine market more before moving over to India. And we believe the reason for moving to India is to keep one of their key employees named Sari Gupta, who is from India.
So now we'll move on to our estimated market value derived from a market approach. For our guideline transaction companies, we use companies that have sales between 20 and 1 million, EBIT between 1.2 and 0.1 million. All of these transactions had happened in the last 36 months, and all these companies have similar profit margins. Now, these are the 8 guideline companies that we are using in our market approach. Based on sales and EBIT, Cerenimbus falls between the 75th percentile and the median. So in this graph, we can see the relationship between sales and the EV/EBIT multiple, and we can use this to estimate a market multiple for Cerenimbus. If we drop Cerenimbus in here, it would fall between companies 2 and 3 based on its sales, and to be more precise, it would fall fairly close to company number 3. Now this position that Cerenimbus falls to corresponds to an EV/EBIT multiple of 8, which we will use as our market multiple. Now with the market multiple of 8 and the 2019 or the base year EBIT of 1.448 million, we come up with a value of 11.58 million. Now, to calculate the price per share with this estimated value, we subtract long-term debt, add cash and cash equivalents, and divide the value by the number of shares outstanding. With the market approach valuation of 11.584 million, we come up with a price per share of $2.38. And now we'll move on to our estimated market value derived from a income approach. As said before, we believe Cerenimbus' forecast to be overly confident, so for our forecast, we dialed down the growth rates. For 2019, we used a growth rate of 12% since Cerenimbus is far away from its projected rate after the third quarter. From 2020 to 2023, we projected 14% growth when the expansion plan was taken into account. And for 2024, we projected 13% because we are entering the late phase of the business cycle, and the GDP growth, which is one of the main drivers of the industry growth, is expected to slow down. In the end, we end up with quite a large gap between our forecasts and the company's given forecasts, as you can see in the graph. For the expenses, we took into account the adjustments laid by the company. Since they seemed reasonable and we believe the expansion to have a more drastic effect on invested capital than to the expected expenses, we kept the forecast ratios for expenses fairly similar. In the end, our forecasts show much smaller expenses than the company's because of the decreases in the revenue growth rate. Now, our forecasts estimate that the company would be operating at a stable 20.75% operating profit, which is higher than the estimate for the company without adjustments, but is still
We will now be talking about discount rates. As you can see, the top two discount rates are for the two offers being made for the firm. Then we have our WACC from our comparable companies, or guideline transaction companies, at 12.48%. We also calculated a WACC using a build-up method cost of equity of 16.19%. We used our build-up method with the variables risk-free rate, equity risk premium, industry risk, size premium, and cost of equity, giving us a total cost of equity of 20.45. We then plug in our cost of equity to our WACC model, weighted at 70.5%, and our cost of debt weighted at 29.5%, or 6% in the formula, as well as adding in our tax rate of 25.95, giving us a WACC of 16.19. Here we're using average historical debt to equity ratios to come up with our WACC. For our income approach, our estimated value consisted of our present value of the discounted cash flows being 2.7 million, the terminal value being 7.9 million, giving us a total enterprise value of 10.6 million. So bringing that down to a per share basis, we plug our value in, our enterprise value, and we subtract out our long-term debt. We'll add back in our cash and cash equivalents, and then divide that number by 300,000, or 3 million, giving us a per share value of 2.08. We will now talk about our estimated value summary and then our proposal. The market approach yielded a 2.38 per share price, and our income approach yielded a 2.08 per share price. We weighted them and then added them to come up with an overall value of 11.22% or million. We weighted our market approach more heavily here because we feel that it is more representative of actual transactions that have happened in the last 36 months, meaning it's more representative of what the marketplace is willing to pay for it. So taking our 11.2 million, plugging it into our enterprise value, and once again subtracting out long-term debt and then adding back cash and cash equivalents, we come up with a new per share value of 2.26. Here you can see the spread between our models and the offers illustrated in the blue text box or the blue boxes for our model on both the DCF and EV/EBIT models. Below it, you'll notice there's a gray line. This is the value of the offers made by the two investors. And then you'll notice that there's a black line going through the middle of both of our boxes. That is the value that we came up with. We want to qualify our valuation by saying we believe Cerenimbus is valued to be approximately 11.2 million. This value is meaningfully above the other offers of 9.4 and 9.3 million. We also don't believe that their projected expenses and invested capital reflect Cerenimbus's current expansion plans. So our proposal is, with considering our valuation of 11.2 million, we propose that the management team buys out the entirety of the company and phases out the PE fund. Mr. Glad can then start training a successor, which will take 2 years and is crucial to the value of the firm. Mr. Glad said in a conference call that he is the only irreplaceable employee in the company, meaning if something were to happen to him, all of the connections within India and the Philippines might be less valuable than they were when he was alive. So we would like to help him eliminate that risk by suggesting that he start training his successor. The PE fund will stay invested, holding 56% of the company in the beginning, and then be phased out over time. We're Westminster investment bankers. Thank you.